Hey, good morning, everybody, and good morning, Texas. First and foremost, how about them Stros? For those of you that are big baseball fans, amazing. Houston Astros win it. Great. There was a parade yesterday, over 1 million participants. So super exciting for Texas and of course, all of our Houston participants on the call this morning. Hopefully you got to watch the game. So as some of you know, and maybe some of you don't, my name's Clint Brown, and I am a shareholder with the law firm Roberts, Markel, Weinberg, Butler, Haley. I'm board certified in Property Owners Association law, as well as residential real estate. And today we're going to be talking a little bit about Insurance 101, what that means to community associations, both condominiums and single family communities. So with that, let's go ahead and get started. We'll start with our disclaimer. I'm an attorney, got to give my disclaimer. The information presented today is based on the law as it exists today, November 8th, 2022. It's also being presented for educational purposes and does not constitute legal advice. So if you need a little bit of legal advice relating to any of the topics discussed, please consult your counsel. If you don't have counsel, feel free to reach out to us. All right, so before we get into Insurance 101, just wanted to talk a little bit about our law firm and what makes us kind of different from other law firms in the state that practice in this area. First and foremost, we have got over 40 years of experience in assisting community associations across the state. We have 3 full-time attorneys that exclusively serve community associations, and then over 30 that do all aspects of community law from developer perspective, whether you're commercial or residential. We also have a robust litigation defense practice group. So when an association gets sued, we've got lawyers that step in and assist as well. That's in addition to our 13 full-time attorneys. Those 13 attorneys do nothing but represent associations, both in their corporate capacity as well as collection, deed restriction enforcement, and bankruptcy and probate. 7 of our attorneys, of the 13, are board certified by the Texas Board of Legal Specialization in one or both of community association law and residential real estate. So suffice to say, we've got a pretty deep bench. And look, ultimately, attorneys come and go, but our law firm will always be there to support our clients, our boards who are on this call today, and then of course mutual clients with managers and management companies. And then finally, it's important to note we've got 50 POA support staff at our law firm. We've also got a bankruptcy department. Mary Shiloh with our law firm is actually board certified in bankruptcy law. She's one of the few, if not only, board certified bankruptcy specialists that is working for a creditor law firm, which is always good. And Mary brings a lot of knowledge base in that area. So we're able to serve our communities from initial plat to declarant transfer, and then of course collection and deed restriction enforcement as well. We've got experience in collections, enforcement, bankruptcy, and litigation. And finally, we do what we're doing here today. We're always going to offer education, both virtually and in person. So if you ever need a lunch and learn or something more personal, please, please, please reach out to our law firm and our marketing team. We'd be happy to assist in that area and help get you educated or get you something a little more specialized for your particular group of communities and or community. So with that, let's go ahead and dig right into insurance. Lovely topic. Something y'all got to deal with. And we're going to talk about the different types of insurance. So we're going to talk statutory requirements for community associations. Then we're going to get into some insurance policy basics. So we're going to talk about the different policy types, and then we'll have some additional topics to hit on as well that may help you in navigating insurance and what it does and what it means. So first and foremost, what are the statutory requirements for single family communities or townhome communities that are subject to Chapter 209 of the Texas Property Code? 209.005M, as in Mary, controls. And it basically says, hey, contracts with a term of 1 year or more shall be retained for 4 years after the expiration of the contract term. Most contracts are annual renewals when we're in the insurance industry. So why in the world do we need to save them? And that's really important based upon the type of policy that you have. There are two main types of policies that community associations deal with. One is a claims made policy, and the other one is kind of an occurrence type policy or accrued. So what is a claims made policy? A claims made policy is a policy that only covers incidents or a claim that happens and are reported within the policy period. So we've got a 1 year policy period. The claim has to happen within that policy, and you have to report it within that policy period. So November 1st of 21 to November 1st of 22, we've got a claim that occurs in March of 22. You have to report that claim before November of 22. If you do not, then, and you're under a claims made policy, then you're stuck. There is no coverage. Unless, and here's the exception, unless you purchase what's called a tail. So claims made, it's you make the claim and the claim occurs within the policy period. Sometimes you can purchase what's called a tail, which extends that policy period 30, 60, I don't know if there's many 90, but roughly 30 or 60 days after the termination of the policy. So November 1st, policy terminates, we've got the claim, we make the claim within that 6-month period or the tail, there will be coverage as long as you purchase a tail. The other option sometimes you can get is what's called a retroactive date. So you've got a policy that covers you from November 1 of 21 to November 1 of 22. So that year period. We've already talked about the tail, which is on the tail end of the policy, right? The tail. There's also a retroactive you can do where you can add time on. So maybe it's November 1st of 21 when the policy starts, but you can add a retroactive period to it for maybe 6 months or something along those lines. So that if a incident happened within that preceding period and you make the claim within the policy period, there will be coverage in that event as well. Geez, complicated. Why is it so complicated? Because we're dealing with insurance. So that's claims made policies. The other type of policy is an occurrence-based policy, lifetime coverage. So as long as the claim, or excuse me, as long as the incident happens or the claim occurs within your policy period, there will be coverage. Doesn't matter if you report the claim a year down the road, 2 years down the road, et cetera, et cetera. There will be coverage, assuming it's a covered loss, of course. And what the benefit, each one offers benefits, but typically an occurrence-based policy is much more expensive. So keep that in mind when you're dealing with your insurance broker and getting advice from your management team and or your insurance brokers. Okay, so let's continue with statutory requirements. Chapter 204 of the Texas Property Code only applies to Harris County associations and Montgomery County associations. So if you're not in one of those two counties, it does not apply. But here's what you can do. Associations acting through its board may, and then it's sub 15, purchase insurance and fidelity bonds, including directors and officers liability insurance that the board considers appropriate or necessary, unless the governing documents provide otherwise. Now, the other statutory requirement that we're going to deal with today a little bit is 82.111. Chapter 82 of the Texas Property Code in this section actually applies to all condominiums in the state of Texas. So if you are a condominium, be sure to look at 82.111 because that has insurance requirements as well. And in fact, if you are a condominium with stacked units, so one unit on top of the other, you've actually got to purchase insurance coverage for units. So not even common elements. You've got to have insurance for the units. And again, the governing documents may provide a little bit of guidance there as well. Okay, so these are some of the essential policies that we're going to be talking about today. Property, general liability, directors and officers liability. I'm going to call directors and officers liability, D&O coverage. Workers' compensation, crime fidelity, cyber active shooter, and we're going to touch base on a few others as well. So let's dig right in with property. Okay, here's the basics for property. It is physical damage to real and personal property owned by the association or property that the association has a legal obligation to insure. Loss of business income or extra expenses required to return to pre-loss normal operation. That's what we're dealing with. What are some claim examples for property? Damage caused by a covered event, fire, water damage, wind, hail, all of that is when your property insurance coverage will kick in. Some sort of damage to real and personal property that is either owned by the association. So what property is owned by the association? We're dealing with single family communities here. So those communities that are governed by Chapter 209, the association actually owns the common area. So you have a clubhouse, it is actually in the association's name and the association legally owns it. What about association has a legal obligation to insure? That's more condominiums. So you've got a condominium with common elements. The association doesn't own the common elements. So you've got a common element pool for a condo. We don't own it. The association doesn't own it. It's actually owned in common by all owners in the community. So if we did a simple 1-to-1 ratio hypothetical where every unit pays the same assessment and we have 100 units, that pool is owned by 1% of 100 of the unit, 1% per unit. So you've got 100 units, each unit owns 1% of that pool. It's kind of like a pie chart. So in that instance, even though the association doesn't own it, they have a legal obligation to insure it. All right, continuing on with property, key coverages and enhancements. So equipment breakdown. Say you're a big community, you've got equipment, you've got your own lawnmowers, equipment breakdown, you can get coverage for a breakdown of different products. Do we want to go down that road? Nah, maybe not necessarily, but for some communities it works. Replacement costs, so the cost to replace whatever you lose. Flood and earth movement, increased cost of construction, ordinance or law, mold remediation. That can be a hard one to get. Named storm deductible instead of an all wind and hail. We're going to talk about a named storm deductible here in a little bit, so I won't go into great detail on that. And then finally, wind-driven rain, where the rain is coming in sideways, causes water intrusion. All of these are kind of key coverages that you need to think about for property insurance. All right, let's move on to general liability. So first one was property, damage to our property. Next one, general liability. That is a legal liability policy to cover claims of bodily injury or property damage by a third party arising on, not from, the insured's premises or from operations, products, and completed operations. It also includes coverage for claims of personal and advertising injury. What is advertising injury? Personal injury, libel, slander, invasion of privacy. All of that is going to fall under your general liability policy. And we see that there's an overlap because this talks about property damage by a third party. So property damage could kick in there and general liability could kick in. So you've got to look at that. And again, you give it to your broker when you see a claim being made, and the broker takes a look at it and determines what insurance is going to cover. Again, there could be multiple insurances that cover and then they've got to figure out who's going to cover what and to what extent. But at least you have got coverage in that instance. Claim examples: slip and fall. Somebody is on the association's common area and there's a big hole. The association is aware of the hole, and owner slips, falls, breaks their ankle. Or this is another good one. There's common elements that the association is required to maintain. I'm going to go with roof. Roof is an easy one to do. And the owner knows that there's a slight leak in the roof. The owner promptly notifies the association of the slight leak, and it takes the association a year and a half to get to it. Well, within that year and a half period, what may have cost $5 now costs $5,000, and it has caused significant damage to the unit. So there may be some liability there when and if the owner sues the association for damaging their unit for failing to properly maintain a common element. So again, the association's general liability policy would kick in that instance. All right, next up, let's go general liability. Here are our key coverages and enhancements. Hired and non-owned automobile coverage, so you can get coverage for that. Employee benefits coverage. Punitive damages exclusion, so no punitive damages exclusion, no assault and battery exclusion. So you've got to try to remove those exclusions from your policy. A punitive damages exclusion basically means if you get hit with punitive damages, we aren't going to cover that. Same thing with assault and battery. If there's an intentional tort, we're not going to cover that. So do your best to get those exclusions removed. Mold exclusion, that can be a tough one. Pollution exclusion, all things to look at, especially if you've got a pool or heating and cooling equipment, or there's painting involved. Pollution exclusion, try to get some exceptions added. And then finally, garage keepers legal liability. This is more for condominiums, but it's all about your garage attendants. Okay, this is another big one. This is D&O, so directors and officers insurance. This is quote unquote the boardroom liability. It's the board did something in terms of an action or failed to do something in terms of not taking an action, and an owner sues the association for that. So this is when D&O kicks in, providing coverage for claims resulting from managerial decisions that have adverse financial consequences. And sometimes there is no adverse financial consequence. So let's say the association has an annual meeting and does the proxy wrong. Well, is it really wrong? Number one, you've got to fight about that. But what kind of adverse financial consequence is there? There's not much. Maybe you've got to resend out your notice and do another annual meeting, but that financial consequence is fairly minimal. What they're looking to do is file what's called a DEC action, or a declaratory action, seeking a declaration from the court that, hey, what this board did was wrong, and it entitles me to my attorney's fees. So D&O insurance also usually includes coverage for claims of employment practices liability, the way you are governing your employees, if you have them. If you don't, then that's more for your management team. Claim examples: we've got a wrongful foreclosure. Hey, the foreclosure was done incorrectly. Breach of contract, wrongful termination for an employee. On breach of contract, sometimes there's an exclusion in there. So you've got to make sure for D&O that there isn't an exclusion for breach of contract. Sometimes it's hard to get a policy without that exclusion in there, so you may just be stuck. But again, something to have a good conversation with your insurance broker on. Look, I get it. Insurance has doubled. Sometimes I've seen a triple with one of my associations in terms of cost. So we really are seeing a significant increase in cost. So a lot of these exclusions that we want removed may not be possible. It may be cost prohibitive. But again, something to have a conversation with your broker about. All right, so here are key coverages and enhancements for D&O liability. We've got a defense outside the limit, defense coverage for breach of contract. So again, try to get that breach of contract included. Entity versus insured versus an insured versus an insured. What is an insured versus an insured? Board member sues another board member. Board member sues the association. Insured versus insured. Board member gets kicked off the board, but sues the board. That could be an insured versus insured. So make sure there's coverage in there. And look, I don't like board members suing board members because guess what? It ultimately just hurts the association in terms of having to pay, because you're having to pay for both costs, both the affirmative claim and the defense of such. Employment practices, again, something to think about. Non-monetary claims in addition to monetary. Make sure non-monetary is included, because again, a lot of times we see these declaratory actions where they're seeking a declaration from the court that what the board did is wrong. So make sure we've got that non-monetary coverage in there. Make sure there's a good definition of insured. You're an association. It's not just your board members that are doing things on behalf of the entity. A lot of times you're going to have committee members as well. And then finally, just do your best to get preferred legal counsel. And I recommend that because POA law is such a unique area of the law, and you need a defense firm that knows the law and has board certified attorneys on their roster, on their bench, because again, of how unique POA law is here in the state of Texas. Okay, next, coverage, insurance basics. We're going to talk about a little bit of crime and fidelity coverage. Fidelity coverage that provides protection of association funds from employee theft can be expanded to include coverage for forgery, alteration, disappearance, destruction, robbery, burglary, computer fraud, extortion, and theft of another's property. So claim examples: embezzlement of funds by an employee if you have employee, by a board member if you're kind of self-managed, or by your manager. So crime fidelity coverage is very, very important to have. Look at the cost, and if the cost is not prohibitive, I recommend you get it. Again, I recommend you get all of these if you can, but crime fidelity is very, very important. It may not happen very often, but when it does, it can be devastating for a community association. And then trying to get those funds back is going to cost you what? Attorney's fees. You're going to have to retain your general counsel to try to go after those funds, or you're going to have to hire outside counsel that specializes in this type of litigation. So it can be very difficult to go after those funds, because many times once they're gone, they're gone. It's not like the person who committed the embezzlement is going to just be able to cut a check and write it right back to you. So again, crime fidelity coverage, very important to think about and look at getting with your broker. All right, so key coverage and enhancements for crime fidelity: limits that satisfy Fair Housing Act, which is 3 months of fees plus cash in bank. Make sure you've got coverage that'll protect you in the event there's some crime that brings you below the FHA threshold. Property manager coverage if needed. If you're managed by a management company, it's always good to have that sort of coverage. Most of the time, these coverages are not that expensive. Employee benefit plan coverage. Again, if you've got employees, get the coverage to cover your employees. Claim expense reimbursement, having to hire a forensic accountant. Doing a forensic audit is not cheap, to say the least. I did one, or well, I didn't do it, but I helped engage a forensic accountant. And this was, I want to say it was around 200 units or so. We ended up paying the forensic accountant $30,000. So it's not cheap. A lot of work that goes into forensic accounting. And then finally, third-party coverage, employee theft of owner's property. So those are key coverage and enhancements that you need to think about for crime and fidelity policies. All right, next up, workers' compensation. We've got a no-fault policy that provides statutory benefits prescribed in state law to the employees or the employees' families due to a job-related injury, including death, that's resulting from some sort of accident or occupational disease. So again, if you've got an employee, you need to get workers' comp as soon as possible, because it really does limit the employer's liability if you've got workers' comp. Claim examples, occupational injury. So you've got an employee, it's an occupational injury, make sure you've got workers' comp in place. So again, if you have employees, please, please, please get workers' compensation coverage as soon as you can. Again, another horror story. This one, let's see, 2022. I think this was 2015. There was an incident for one of our community associations, a summertime employee. You know, they opened the clubhouse during the summer. They had a kitchen that they would provide food to people, you know, kind of like a concession stand, a summer concession stand right next to the pool. And somebody, one of these summer employees, and again, it was, we were having difficulty determining whether or not it was an association employee or a management company employee. Employee got severely injured on that, and there was some coverage issues. And had the association had workers' comp in place, it would have been a completely different discussion, because workers' compensation, they get paid X, and as long as you've got coverage, you should be protected. So key coverage and examples for workers' comp: minimum premium policy if no employees. So again, you don't have an employee, but you're a big enough community where you have folks working on site, and it's not crystal clear on whether or not they're an employee of the vendor, or maybe they're a quasi-employee for you. There's a term of art, it's called dual employment, where the court can find that you're an employee for both entities, both the vendor providing the service and the association. So if you get this coverage, it'll cover in that instance. It's borrowed servant, dual employment. And again, there may be some coverage for failing to report a mid-year hire, and increase your employer's liability limit to meet your umbrella coverage requirement. And we'll talk about umbrella insurance here in a minute. Oh, geez, so much information on insurance. I'm sorry. This is a lot of information. So again, these slides and the presentation will be available in a couple weeks for you to go back over. All right, next up, active shooter insurance. Why do it? So some of you may have heard about these shooting incidents that have occurred across the country. And they've involved managers, they've involved owners, they've involved police officers serving a lawsuit or serving foreclosure papers. And an active shooter gets involved and injures somebody that is part of the association. So why do it? Do you have to have it, or is it more for economic security and reputation? Make sure there is coverage there to protect the association in the event of an active shooter incident. And again, speak with your broker about active shooter coverage. Look at the costs, and you can do a cost benefit analysis and determine whether or not you want to spend money on this type of coverage. It typically covers counseling, funeral costs, media relations assistance, and other items. Again, get with your broker to figure out whether or not this is some sort of an insurance policy that you want to consider. I will say this, you typically see active shooter coverage more often for high rises and mid rises, and that's merely because you've got all your unit owners in one structure, and they all have to use those common elements and have to go by the front desk. So again, speak with your broker about active shooter coverage. All right, next up is an umbrella policy or an excess liability policy. Legal liability policy that provides excess or additional limits when the limits of your underlying policies are exhausted through the payment of claims. It's designed to provide protection against catastrophic losses, fatality, injury to a child, life safety. Look, you've got a pool, and heaven forbid, but a swimmer gets injured or dies while using the pool, a drowning, for instance, you need that umbrella coverage to protect the association in the event the association's liability, or excuse me, their insurance limits are reached. So again, umbrella, as the name implies, it sits up top, and you've got your insurance policies right below it. So when the insurance policies cap out, you've got your big coverage, your umbrella right here, to provide additional limits when those underlying coverages are reached. All right, coverages and enhancements follow form for umbrella: general liability, auto liability, D&O liability, employee benefits liability, and then an employer's liability, workers' comp policy. You have to get all these underlying coverages in order for the broker to be able to get you umbrella, right? Because the broker's like, well, I'm not going to get you umbrella if you only have 2 policies, because I don't want this coverage if you're not minimally covered in our opinion. And it's, insurance company's opinion. So you're going to have to get the coverages that they're telling you have to get. So keep that in mind when you're speaking with your broker about getting excess or umbrella coverage. All right. Been talking about brokers left and right. Been passing the buck on those gentlemen and ladies. So what is an insurance broker? And I just got a good comment from one of our managers. So brokers are reporting difficulty in getting umbrella coverage. So again, speak with your broker, see whether or not umbrella coverage is even a possibility for y'all. And if it is, look at it from a cost benefit perspective. So let's talk brokers. Is your broker a specialist? And I'm not talking about specialist in terms of real estate. I'm talking about a POA specialist, a broker. That's it. They do is property owners association policies, or if it's not the only thing they do, it's a significant chunk of their book, of their business model. Number one. Number two, do they have what's called the CIRMS designation? So the Community Association Institute, or CAI, is a national organization, and they give a lot of designations for managers and for insurance brokers. CIRMS stands for, what does it stand for? Community Insurance and Risk Management Specialist. Community Insurance and Risk Management Specialist. A CIRMS designated insurance broker has to go through some rigorous, basically, classes. They've got to do tests, and it basically turns them into a specialist when it comes to community association policies. They know what you need as an association in the state of Texas, and they can give you that advice. Develop a good relationship with your broker. Will they recommend what you need, or only what you ask for? I want the former. Y'all are volunteers, right? You're not expected to know the ins and outs of insurance policies to get. Managers, y'all are managers. Again, you are not expected to be experts in the insurance policy arena. So who is the expert? It's a CIRMS designated insurance broker or agent. So speak with them and say, what do you recommend? And again, you can list off a lot of these policies that we're discussing here today, but ask them what they recommend so that they can look at everything, make a determination, and give recommendations based upon the type of community you are. And guess what? They know how to do it because they're designated as a CERMS insurance agent. So again, it's not a be all end all, but that can be helpful because they can still be very good at what they do and not have the CERMS designation. But again, something to think about. That CERMS designation does help. Okay, so that's our baseline coverages. Let's talk a little bit, some additional coverages and additional topics. Property coverage amount. Most governing documents require full replacement cost of the common areas or common elements, and possibly an assigned portion of the unit. But C for condominiums 82.111 of the Texas Property Code. 82.111, which applies to condos, requires at a minimum 80% coverage. And if you have stacked units, which is one unit on top of the other, you've got to insure the units as well. But again, as I mentioned, most governing documents for condominiums require 100% coverage, period, end of sentence. So look at that, compare it to 82.111 if you're a condominium, and if you're a single family, again, just make sure you're complying with your governing documents. Adequate limit is vital for single building risks, period, end of sentence. You have to have proper limits. Well, how do you know what it's going to cost? You get what's called a certified insurance replacement cost appraisal. And you may have to do that every so often. So every 3 years and after capital improvements. So again, get that insurance replacement cost appraisal, get it updated every 3 years. But if you add a new capital improvement or you do a complete gut job and remodel of your clubhouse or something along those lines, you need to get another insurance replacement cost appraisal done. Confirm the property policy has replacement cost coverage, no co-insurance or an agreed amount, and then blanket limits if available. And again, I've heard this, and managers, y'all deal with this a lot more than I do, but there's a lot of coverages that we're discussing today that just aren't available. Your insurance broker agent just can't find it. It is not on the market right now. That doesn't mean it won't get back on the market in a few years, but right now insurance is tough. It really is. Okay, named storm deductibles. So we've got a named storm. We're a community in the great city of Houston, Texas, and it hits us, and it hits us hard. Hurricane Ike hits us hard, and we've now got this massive deductible that we've got to come up with to repair our common elements. If we're stacked units, to repair the units. How do we finance that deductible? How do we do it? Well, option one, pay an additional premium to buy down the deductible. And the buy down rate may fluctuate, but it's something you can add on. So maybe that's an option. Number two, maybe you've got enough in your reserve funds to pay the deductible. Maybe you've got the reserve funds that are in compliance with the reserve study, and you've socked away money to pay for deductibles. Got kind of a deductible bucket or piggy bank. Or what if you procure a loan? You obtain a loan. How do you pay that loan back? You do it by levying a special assessment and then maybe slowly increasing your regular assessment over a period of time. Now, you take out a loan, you get a special assessment. Let's assume the board can levy the special assessment. Let's assume the owners don't vote on it. Well, for unit owners, so for those of you on this phone that are unit owners in a condominium, make sure you get what's called loss assessment coverage, so that if there is a covered loss and you have to pay that special assessment, if you have a loss assessment coverage rider or add-on, the insurance pays that special assessment or maybe a portion thereof. And it's been my experience, or from what I'm told, I've never been a condominium unit owner, but from what I've been told, that coverage is typically fairly low. It's not that expensive to get. And then finally, if you don't have that coverage, you're going to have to just have unit owners pay out of pocket. It is what it is, but the association has a trust obligation to get the community back in good shape. So again, things to think about. Good maintenance program and hurricane preparation and response plan is critical to limiting damage. So if you are in an area, i.e. Houston area, that or the Valley, or kind of the Corpus area, Port A area, get a hurricane preparation and response plan in place. Figure out what your named storm deductible will be so that you know what you need to do in the event it happens, to you, so that you can act quickly and effectively to get it addressed. Okay, so that is our 101. Man, that didn't feel like a 101, did it? That was a lot of information. Sorry about that. But again, you can listen again to it later on and kind of, get a copy of these slides so that you can speak with your broker about it. So Insurance 201, we're going to get into what a claim is, what it is not, how to properly file a claim. Number 2, reserve studies, how reserve studies work kind of hand in hand with insurance. Responsibility for maintenance. Oh, that's a tough one, especially for condominiums, right? I mean, you look at these condominium regimes and sometimes it's just not spelled out. The attorney, we do the best we can, but sometimes there are instances where it's not the clearest. Hoarders, how do you deal with hoarders that start affecting the health and safety of neighboring units? When you're on stacked units and you've got a hoarder up here, it will eventually affect units to the side and below that particular unit. And then we're also going to talk about other laws that deal with insurance. So look forward to Insurance 201. And with that, we will move into a little question and answer. So let's see what we've got here. All right. So one good question from one of our participants: struggle with the RCV evaluations for property coverage. Let's see. And so sorry that it popped out in and out. So I struggle with RCV evaluations, so replacement cost evaluations for a high-rise property coverage, and they don't seem to cover total loss. Underwriters require an RCV that doesn't seem to meet a total loss, and just not getting good answers. What do you do in that instance? Get with your counsel. He, she, or they should have a kind of an insurance defense team that knows how to push back a little bit so that you can get some good RCVs out of them. That's what our law firm does. We've got one of our equity shareholders, Greg Godkin, deals with these all the time. And so sometimes you've got to get with your general counsel to get a little bit of assistance. All right, as for insurance, what if association leases out the clubhouse, golf course, etc.? What if it's developer controlled? So what do you do? So if you are renting out a facility, number one, require that and let's assume it's an owner, require that the owner get insurance coverage. I mean, I like to, for bigger communities that have very big clubhouses, I like a facilities access agreement that specifically lays out the type of coverage that the owner needs to get to cover that particular event. But yes, you need to get that additional coverage. And then what if it's developer controlled? Again, work with your developer team. You may just be one board member, but many times the developer wants to reduce liability potential as well, and they're willing to listen and work with you. There's also, one comment, there's also coverage for parking if the association provides valet. Yes, sir. Absolutely right. So it's kind of that garage keepers type coverage. Next question, already addressed that one. Oh, is there any reason to require that your 1099 contractors have workers' comp and provide proof? So again, I like to require vendors to have workers' comp. It's legally not required in the state of Texas. And if they absolutely do not, there is a form that they can fill out and provide to you that helps, from a liability perspective. I don't know the form offhand, but again, if that's something you want to investigate a little bit further, get with your general counsel. They should be able to assist you in that regard. Follow-up question here. This is a big question. Our documents require that owners carry liability and replacement cost insurance and provide the HOA with a copy of the policy. Oh boy, our 20-year-old HOA has not enforced that. Is it possible to enforce, and should we? And they're a townhome community. So yes, you should start enforcing that, because again, insurance renews on a yearly basis. So it's kind of like a new bite at the apple every year. But yeah, if your documents require this, you need to enforce it. You need to make sure there's proper coverage in place. So this sounds like a community, a chapter 209 townhome community where the townhomes have shared walls, right? So you've got like a building of 5 townhomes with shared walls. There's no insurance coverage for the association, but the association requires each townhome owner to have proper coverage, property coverage. So we've got 5. What happens if the center one burns? Now you've got 2 and 2 on either side. What happens if it transfers to those other units? And that middle unit, that middle townhome, has no insurance coverage. Is that townhome ever going to be rebuilt? 0 insurance coverage. So again, when you're dealing with that very unique situation, I think it is important to do your best to ensure there is proper insurance coverage. Some insurance companies will not pay a loss assessment if the special assessment is to pay a deductible. So again, make sure your loss assessment coverage includes deductibles. My townhome community is gated, so has a private road drive parking with a storm water system that was built by the developer and empties into the city of Houston. In the past, boards have not considered concrete or storm sewers for reserve purposes or insurance purposes. Our broker is looking into flood insurance from the state. I'm concerned that the cost of insuring under asset coverages is so high and excludes the potential losses that are most likely. So again, if the association owns the systems, you need to do your best to get coverage. And it may be cost prohibitive, but if it's not, get the coverage. Get the coverage. Okay, so we'll do one more question here. So back to the townhome example where the association has an obligation to make sure the owners are insured. How do you do that? Well, you send a letter to the owners and you say, hey, you have to provide proof of coverage by date certain, whatever the date is. If you fail to do that, the association will purchase the coverage for you and bill you back for that cost. So again, I dealt with a community like this. It was in Houston where we were able to get coverage, where the association could buy it on behalf of the owner and bill it back to the owner, that cost. So that may be a possibility for you. And again, you bill it back to them, and maybe, assuming you've got a fine and enforcement policy, you levy fines against that particular owner again. So those types of situations, I guarantee you that owner in the future is going to be providing proof of coverage. See any more? Just popped up. The limit to how much an insurance premiums? Insurance premiums are just kind of governed by the market. And right now, it's just not good for associations across the country. Environmental policies popping up with viruses, bacteria, mold claims. Yes, we do see mold claims every so often. So is it a good idea to get some sort of a policy to cover that? Yes. Make sure you explain the situation to your broker and ask them to basically whether or not the environmental coverage you're going to get, or maybe it's liability coverage you're going to get, would cover this particular instance. I think that is, let's see if there's any other else that is in. Coinsurance, what is it? It's basically an agreement between insurance and a business owner to share the cost of a claim. So you cover a percentage of the property value in order to receive full compensation if there's a loss. All right. Well, hey, we got out a couple minutes early, but you still get oh, wait a minute, follow up. All right. What does it mean when it says 100% coinsurance? That means your coverage limit cannot be less than 100% of 100 grand. So if your property is valued at 100 grand and your co-insurance clause requires 100% coverage, that means your coverage limit cannot be less than 100% or 100 grand. Oh, hey, thank you. And everybody make sure to vote, right? Today is election day. So please get out there and cast your ballots. Very good point. Thank you for that. All right, everyone. Well, again, sorry for the dense information. I hope y'all got a little bit out of it today. As I mentioned, the slides and the presentation will be available in the coming weeks, so you can refer back to it when you're finally going to have a conversation with your insurance broker. And as always, if there are any other questions or concerns, you're always happy to reach out to our law firm. We're here. We're not going anywhere, and we plan on doing business for a lot longer. With that, y'all enjoy your day and enjoy the rest of your week. Bye, Texas.